When I think of the clean energy transition, I mean, I think this is a pretty broad term, but largely it encompasses kind of the blending of a lot of different technologies to get at a ultimate goal of decarbonization and limiting impacts of climate change. Along with that, I think this is also not a new concept. It's something that's been ongoing, and a lot of the companies that are working in that area have been doing so for multiple decades in some cases, although recently gaining a lot of speed. In particular, I think the things that are really interesting to me right now is just how much momentum the field has gained in the last, call it 24 months. And some of that is fueled by, I think, an awakening of the policymakers and general population to dramatic need for solutions to the global climate change problem. And talking about electrification, like larger themes that are overlapping, like electrification, the need to decarbonize hard technologies in industrial industries, and also shift power generation to cleaner base load and renewable sources. But what's followed a lot of that change in thinking has been a massive amount of capital flowing into the area as well. So we're looking at commitments from large corporations. So now kind of seeing, 100% plus kind of CAGRs in the number of companies that are signing on for commitments to net zero. And we're talking about net zero by 2030, 2040, 2050. So individual companies piling on top of countries doing the same thing. We just came off of the back of the COP meeting, and we're very excited to see the additional commitments. And I think a lot of it, you've seen a very quick response from like the IEA updating their forecasts to show that just based on new commitments, we have stated policies that can limit temperature changes to previous 2.1 degrees, now down to 1.8. So things are trending in the right direction, and there's just a lot of energy, I think, and momentum. And this is very broadly speaking, but the capital is also there to just make this happen. So beyond the commitment, there was a flurry of de-SPAC activity towards the end of last year and the beginning of this year that was very hard to miss in terms of tens of billions of dollars getting deployed against new technology that was typically in prior markets very hard to finance. So there's also this shift in investor appetite, and I guess that's also them kind of aligning with the realities and the long-term objectives that are being established by countries. So I think those are kind of like the main things that I'd point at. Just overarching, it seems like the tide is shifting. New currents are developing, and everybody's getting on board. So the corporates, strategic investors, and financial players. So just massive amount of dry powder sitting on the sideline as well. So on top of the SPAC markets getting activated, there's also new ESG funds getting raised. So, and those are ready. I think every month, every couple of weeks, you just hear new announcements of billions of dollars getting raised to go after these new technologies.
Super. And same question to you, Yuliya, and then a follow-on question. Ryan mentioned COP. So what are some of the key reflections from COP26 and the capital needed to meet the ambitions set up by global leaders? So Yuliya, some key trends, and then key reflections from COP.
Sure, happy to, Mark. So over the last 12 days, McKinsey did have the honor and opportunity to engage with tens of thousands of leaders around the world in sessions, helping them think through the practical actions they can take to decarbonize their assets, reduce their enabled emissions, and just build resilience and launch new sustainable business. And compared to all the COPs in prior history, it was very clear that COP26 was anchored around the private sector as much as it was around the governments and the actions they need to take. And the transition to net zero will require the largest reallocation of capital in the history, as stakeholders aim to rebuild an economy in 30 years that took us 200 years to build. So just to set that. And the answer will differ across sectors and geographies. And while the challenges do remain, I think what COP26 did achieve was they articulated the problem, and it is being understood at many levels. So as of today, $130 trillion of financial assets are committed to net zero. But the capital needs are way far more than that. We estimate that 275 trillion of capital is required to achieve net zero by 2050. And so to put in perspective, the annual investment needed is larger than most countries' GDP. And this, again, going back to our analysis, it suggests that it's about 9 trillion a year for the next decade that we need, covering all investments into energy and land use. So that includes a 60% increase compared to our current annual spending. So $3.5 trillion of new net capital is going to be needed to be formed, plus $1 trillion of capital that will need to be reallocated from high emission assets to low emission assets. And so the incremental spend of $4.5 trillion is equivalent to about half of all global profits, a quarter of all global tax revenues, and about 7% of household spending. And so that brings us to this three-legged stool of policy, technology, and finance that will be required to get solutions at scale, and venture capital is going to be a big part of that equation.
Excellent. Wow, that was a fantastic answer, Yuliya. I really appreciate that. Ryan, how are investors, and Yuliya, if you want to chime in afterwards, how are investors evaluating financial attractiveness of emerging technologies? And Rusty, I might have you, ping in on some of your experience on that if you want to, and then Jesse Teekman also, if you want to kind of pop in on that, feel free to do so too. So Ryan.
Yeah, I think beyond just the valuation techniques that are involved, I think one of the things that's happening is investors are starting to look at longer investment horizons for returns. And now that doesn't necessarily change the hurdles they need to clear in terms of ultimate return. This is not. I think investors aren't looking at this as social investments, but rather are trying to generate attractive returns off of an emerging asset class that's very appealing. That said, in order to evaluate what is, I think, an intrinsically difficult class to get your head around because of the out year revenues and the huge growth factors that you're trying to bake into these investments, you have to look at a few important points on each of these companies or technologies, and those include first, I'd say, the product validation that you're looking for proven technologies, and that can be, and then second, I'd say you're looking for the disruptive potential, the presence of strategic partnerships, and also scalable business models. So each of those has, I think, a number of important factors that you need to consider. Like when we start with the technology component, the breadth of what's being covered by clean energy transition, whether it be alternative fuels like hydrogen or renewable energy, or renewable natural gas, distributed energy resources, grid management software, they all involve very innovative solutions that and very distinct technologies that of themselves belong to sometimes completely separate but verticals from each other, but are now being meshed together and results in the need to very quickly get your head around new science in some cases, or unproven technology. So what do you do to bridge that gap? I think something that's working well is demonstration projects. So and a prior track record of hitting milestones over the past 5-10 years, et cetera, that these companies have been in existence. The other thing that I think you'd look to is the management team themselves as a way of validating the technology via the right board membership, participating with scientific literature, et cetera. But basically, we're trying to look for as many data points as possible to show that the technology risk is minimal relative to the and it will lead seamlessly towards like the commercialization path. The other thing I'd say, like when you're looking at the disruptive potential, there's a few different ways that you can measure that. One is just in terms of, well, what's the total addressable market. Often that's fairly easy to point to just because of the current context on limiting climate change and some of the numbers that like Yuliya was mentioning with the massive amount of investment that's required, and when you segment that into what's required of specific segments of technology like carbon capture or again hydrogen or a number of batteries, et cetera, then the large figures are very easy to get to. So then it becomes a question of, well, what are you doing differently? What is disruptive about how you're getting there? You have a first mover advantage that allows you to become a market maker in any one of those verticals, which is something that prior companies have been rewarded for. Like if you look at the folks that were first to arrive at some of these solar mounting technologies, et cetera, that went to the public markets, the first movers have been repeatedly rewarded as time and have endured over the last 12-24 months, even after going public, even after many others have followed. I think I also mentioned strategic partnerships, because these are new technologies in new markets. They often involve a large number of incumbents, though. So in order to be successful, so we're thinking in terms of what can you point to in terms of funding momentum, which is often a way that investors have to get smart on things very quickly, is by looking at who else has vetted this technology and who else is on board, or in terms of other private capital or strategic capital that's thrown their weight behind the technology already. In other words, who are the lead investors from prior rounds or the current round? How can you use strategic partnerships to lower the co-innovation or co-adoption risk of a new technology as well? So usually these new technologies, again, we've mentioned that these technologies are very integrated. So when you're talking about batteries, you have to also talk about solar and wind, and you have to also talk about the various markets that those participate in. So there's a certain amount of co-innovation or adoption risk that can also be minimized when you have the right partners that are operating in those adjacent spaces, that can show that they could help with the build out, or they have the right connections or supply chains to assist in development. And I guess the last thing is that, there's, when we're talking about a scalable business model, you can point to one, the type of, how the revenue itself is collected, whether that be like royalty. Oftentimes a popular approach seems to be a licensing and royalty model, which kind of is cooperative with like the strategic partnership. By pursuing a royalty model, I think you can get to market, ideally get to market faster, but that's not the only way to do it. I think that even more fundamental is probably what are the margins or the unit economics that are going to support this as you scale up. So important to that would be understanding what the learning curve is on your new technology. I think that solar panels, for example, have benefited from rapid cost decline as that ecosystem has been built out. And I think the hope is that other technologies can do the same. The question, of course, is like, how fast can they do that? How many demonstrations or next of a kind deployments are required before you can get there and then hit attractive economics that can compete with currently mature technologies? Like when you look at the existing renewables or natural gas plants on the market, et cetera, and what are their levelized costs of electricity, as an example, how are you going to get to a competitive number, and how long is it going to take you to do that? So I guess those are a few data points that I'd point to as being important.
Ryan, it sounds like you know what you're talking about, sir. Great. That was a fantastic answer. Yuliya, would you like to chime in also?
Following that, Ryan's close to the ground on those comments. I would say, because McKinsey has an extensive knowledge on what technology exists right now and how much is there is to be, and it's no question that technology is going to be one of the most critical parts of the world's decarbonization toolkit. And we do not have yet all the technologies to solve the net zero equation. The good news is that we do have about 60% of climate technology that is already mature and could deliver about 60% of the emissions abatement that will be needed to stabilize the climate by 2050. The challenge is that the further abatement must come from climate technologies that aren't quite ready. So including about 25 to 30% from technologies that are demonstrated, but not yet mature, and another 10 to 15 that are still in R&D. So and just the amount of capital that we are talking about, we estimate that the next generation climate technology could attract $1.5 trillion to $2 trillion of capital investment per year by 2025. And so it is clear that we will need to be creative in the finance vehicles that are available for companies, governments, startups, private equity to be able to fund this, because we're not seeing the returns right now that private equity world is used to, and that's kind of the challenge, but the opportunity is definitely there. I see from the audience, there's a lot of people that are working very hard on scaling these technologies to the rest of the world. So thank you.
Thank you. Rusty, do you mind chiming in on that briefly?
Yeah, thanks, Mark. And I'll try to keep this brief, right? So I've been on both sides of the table, as you well know, right? So up until about a year ago, working for a major international oil company, deploying new technology within that company, upstream, midstream, downstream, being involved in the venture side, selecting new startups, field tests, evaluation, et cetera. Now I'm on the other side, right? So now I've partnered with some newer technologies, technology companies. Some of them have early stream revenue. Some of them are earlier than that. And being on the other side, it's really difficult to really get funding. And we're usually not asking for a lot, for a couple of the ideas that we want to prototype and field test, we're talking a few $100,000, maybe less. Others we're looking for 1 to 2 to scale up. And it's really hard to get people's attention. Everybody's busy. They're hardly able to get to their emails. When we get through the barrier, yeah, they're real interested, but they ask a lot of the questions that I think it was, the prior speaker or two, were referencing. They want revenue streams, they want proven this, they want proven that. Well, some of the best ideas I'm finding on the other side of the table or the fence are the really new innovative companies that are just trying to say, hey, look, with a little bit of help here, we can prove what we can deliver and scale. But, you know, those early startups, there's so many of them, I think, and they are largely maybe unproven. It's hard to get anybody's attention. And a lot of them, all of them actually have an ESG component where they either run off a 120-watt light bulb to generate biodiesel or water cleanup for a municipality. And that's not an LED light bulb, right? That's an old 120-watt light bulb. Or in some cases, right, with multilaterals, and I know Ernie's on the line, right? There's not only a 25% cost savings, but there's a 25% carbon reduction with scope 1 and scope 2 with the amount of emissions products that you need to do further oil and gas, geothermal, or CO2 sequestration development. And, you know, we were on a call earlier today, everybody's, you know, rah, 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 but all the companies are on the sidelines because they're waiting for somebody else to go first.
Nice.
So I don't know that, you know, I'll leave it there, but if you got any questions, I'll try to answer them.
Thanks. Yeah, and I picked you on purpose, Rusty, because I know you've been on both sides of the equation. And folks, you can look up Rusty online, and you'll understand why. Jesse,
if I can mention one other thing, Mark, real quick, wave energy.
Of course.
Right? We think that's a forgotten renewable energy, right? When you speak renewable, they go to solar first, maybe wind. You know, everybody wants in on hydrogen. But wave energy has been a lost leader. So, you know, Ernie's on the line, right? We've got to start up with wave energy. And we think we have a design that can generate as much electrical power from a 6-foot, maybe 8-foot pod at the most, as a 300-foot windmill. And, you know, there's some good innovation out there, but it needs some assistance. Thank you.
No, yeah, I appreciate that. These are all the things that I learned in school, and wave energy was definitely one of them. So, and I know Roy Robinson has a component of wave energy in his startup as well.
Yeah.
Jesse Teichman, if you would you like to chime in briefly? Thanks, Jesse.
I would, Mark, but I've sort of forgotten the core question. Was it kind of what's it
No
gonna
worries.
take,
It's all gravy. How are investors evaluating financial attractiveness of emerging technologies? And Jesse, just briefly tell us who you are again.
Yeah, Jesse Teachman, again with Chevron Technology Ventures Future Energy Fund, where I've been for the past 4 years and the past 13 at Chevron. I would say that's actually a nice lead into my answer, which is that, you know, I'm sure there's a bunch of people on this call who, like me, were around for clean tech 1.0, kind of in that 2006 timeframe. And it's a different world here right now. I think in the 1.0, we were seeing a lot of really strange plays, to say the least. You know, for every 10 business plans you might see, you're probably lucky to find 2 or 3 that are kind of in the ballpark, and then maybe 1 or less than 1, obviously, that's going to be investable. And you know, as a function of just a lot of money pouring into the sector, primarily, you know, what was tech money coming in without a clear understanding of the sales cycles and the adoption cycles that you see in this space. But you know, you regularly see business plans that would kind of violate the second law of thermodynamics. That was a feature, not a bug, I would say, in those days. Fast forward to today, you get 10 business plans, you're going to see probably 9 of them that are going to be cogent, and the numbers are just overall better. The entrepreneurs are much more sophisticated. I think the infrastructure is just tremendously better. You know, the universities, the incubators, the accelerators have all done a tremendous job sort of operationalizing, let's call it clean tech, climate tech startupism, you know, to help put together cogent business plans that are contextually aligned with where the world is, what the adoption and sales cycles are. And so, so today you're seeing a lot of really good sophisticated business plans, but some of the endemic problems or endemic challenges still persist, namely the value of death idea. You kind of get through your Series A and Series B, and then you have sort of this funding gap. Rusty and others have talked about sort of this idea of, a lot of the capital is kind of like, well, prove it to me, show me what you're doing on revenue. At some point, it's like you got a hardware company, it's like, show me what you're doing on EBITDA. And the entrepreneur is saying, well, I've got this demand, but I've also got this tremendous CapEx to build up capacity to produce against that demand. And so we're sort of in this squishy zone that we don't know how to get out of. And I think one thing that's happening there is you're seeing a lot of use of contract manufacturing, for good or bad. It might be harder to protect your IP and protect your quality control and margins through contract manufacturing. It might jumpstart your ability to get to market, though. On the other hand, we've seen some really, let's say, ugly instances where people have raised dilutive venture capital to like build a factory, and the factory became obsolete before it produced its first widget. And so you got to be thoughtful, I suppose, about that trap. And so we're seeing kind of some hybrids between those two models, where people are maybe jump starting with contract manufacturing, but with an eye toward very rapidly pivoting toward in-house, organic manufacturing. And then the last thing is, I think that the financing itself has evolved. It's become more innovative. You're seeing some VC firms that are putting in differentiated capital, namely, certainly kind of the dilutive venture equity that goes into the startup parent to grow, but also you're also seeing some early stage debt start to layer in there from sometimes the same firms, to kind of help just provide working capital to get some of these business models through the quote unquote value of death cycle.
Excellent. Thank you. I really appreciate you contributing to the conversation, Jesse. And we have a question from the audience. Sunny, if you want to unmute yourself and ask it yourself, feel free to do so.
All right, thanks, Mark. I think my question came in perfect timing, following Jesse's point about the catch-22, right? In my opinion, there's actually not a lack of technology. What's lacking is technology transfer. Too many brilliant founders. And I'm having a conversation right now with Tim in the chat as an example. They have the water purification technology that can help with, saltwater deterioration and so on. There are just tons of examples of early stage startups stuck in that valley of death and the chicken egg kind of dilemma, where you have to prove it for me to fund it, and then if you don't fund it, I'm never going to be able to build it to get the traction. So I just wanted to get the insights from the panelists in terms of how can we address that. I think it's especially challenging for oil and gas, for energy transition, just because comparing with other industry, it's even a bigger problem because the amount of funds needed in the early stage.
Thanks. And Sunny, tell us who you are and what is it you do as well, please.
All right. Thanks, Mark. So I am the founding partner of Z-Lab Ventures. We are a venture studio and a fund that not only invest, but also build impact-driven startups in the areas of energy transition, future of learning, and sustainable e-commerce. Given the background of myself and my general partner, Sandeep Bordeloy, who has 2 decades of experience in energy. So essentially, I'm asking because we're trying to address that early stage venture building and investing gap through the venture studio model, which invests not only in financial capital, but also in intellectual capital, which is the know-how, the human capital, which is the team of talents, and also the social capital, which is the network and the connections. Because as Jesse said, right, there's a lot of areas that's beyond money. It's not a problem that money alone can solve.
Super. And I'll just reiterate the question. What's your view on bridging the gap in early stage venture building investing? And that's to the audience. Do you want to take that, Ryan?
Yeah, I'm happy to take a shot at that. I think it's a really interesting topic because it's almost like information overload in a lot of ways. I mean, when you're looking at the landscape of what you could deploy capital into, and there's literally thousands of companies at very different stages, many of them promising very similar things, some of them promising identical things, but with different technologies. So there needs to be some basis for comparison for a layman who doesn't have the benefit of, you know, all the research and development that's gone into developing that idea. And I think there's a few things that people are going to point to, and probably one of the biggest ones is, or the two biggest ones that I can think of are going to be, well, what's your you're not necessarily going to be expected to have revenue or cash flow when you're getting your first funding, because a lot of people are understanding that by the nature of this investment class that it's a little bit harder capital. It's a little, needs to be a little bit more patient, but they will want to see your pipeline. Like what's the actual rollout strategy, and what's the milestones that take you from point A to point B. So if you're at the earlier stages, a couple of the first milestones they're going to want to see is like the demonstration. So what's it going to take to get the demonstration done? And what does that demonstration prove about your technology? Is it proving the economics? Is it proving the scientific viability? And if it is, just if it's the scientific viability, then what's the next project that'll take it from science to commercial? And then how do you go from that commercial project to then selling the plant? So you have to, I think it's all about creating a very clear roadmap that people can follow and they can check off. So if they can't use standard, for example, cash flows, historical cash flows to value your business, then then they're going to have to rely on your milestones as a way to make sure that you're making progress and that they're investing against milestones. So I think that's at least one thing. I guess I'll pause there.
Perfect. Thank you very much, and I want to thank this group as well as we're in the meeting. This is a very engaging conversation, and I'm very excited. I can feel the energy, and I can feel implementation, and I know connections are going to occur afterwards and during. So thank you. Okay, so I want to introduce, last but not least, the illustrious Miss Grace Chan from BP Ventures. Grace, if you can give us a little bit about your background, and then chime in on the last question about your view on bridging the gap in early stage venture building and investing. Thank you.
Thank you, Mark, and hello, everyone. And hey, Sunny, I just saw Sunny for lunch yesterday, so good to see you again. Grace Chan with BP Ventures. I'm a BP lifer, but was BP the entirety of my career, almost 14 years. I have a commercial background, worked in oil and gas on some of the biggest assets BP owns, Thunder Horse, Wamsutter. I transitioned into ventures about a year and a half ago. It's been the best move for my career because I really enjoy the role. I think it's really meaningful to work on energy transition. So now we're clean tech investors in this space. A little bit about BP Ventures. We've been around for about 14 years. The asset under management is roughly 850 million. We made investment into 70 or so companies. There are 45 still active. And BP Ventures were very active investors, meaning we take board seats, and alongside our investment usually comes with a commercial agreement with one of BP's businesses. And we value the companies from both strategic lens and financial lens. Earlier this year, we've had 2 public exits for our portfolio companies, so that's quite exciting year for us. And then to answer the question from Sunny, I agree with everything Ryan has said. Truly, it's to show the demo and the sales pipeline are the 2 key pieces. Let me talk a little bit about how the founders actually got money to build it. Some of the companies that we invested in, bootstrapping is one of the options. I've seen founders build prototypes out of his garage. And then there are two other ways I think you can raise from friends and family in the first few rounds at a low valuation. You can access safe. And then thirdly, there are actually a lot of grants that actually can help you further along or speed up your development of your technology. I've seen some great innovation come out of Canada, and Canada has a really good grant matching process. So that's just to complement Ryan's answers, demonstrate your sales pipeline, and at the same time, show us the demo.
Super, thanks. And for those that don't know what a SAFE is, can you define that for us, Grace?
Sure, it's one of the funding mechanisms that's originated out of Y Combinator. We've actually seen some of the companies we invest in, they use SAFE. Let me think, you're putting me on the spot to see what it stands for. All right, please Google it because I don't want to say the wrong thing.
I can phone a friend if you want. And
all right, phone a friend, phone a Chevron friend.
Simple agreement for future equity. It's kind of like it's too early to really understand terms and valuations, but an investor knows that they want to support the promise of the technology, and so the SAFE note effectively converts into the next proper funding round at a valuation or perhaps a discount to that valuation once that round occurs.
Excellent.
Thanks, Jesse. I need to buy you a drink next time.
Yeah, and that's what this is all about, communication and connection and community as well. So thank you. All right, perfect. So I'm going to recircle back to COP and go to Yuliya. What is the significance about the location of COP27 in Africa?
Sure, happy to address that. As we talk about energy transition, McKinsey analysis suggests that lower income countries, for example, would invest more than others as a share of GDP to get to net zero. We're talking about 1.5 and 2.5 times in Africa and India as it is in Europe and North America. And that's just in large part due to a rapid economic growth and the needed expansion of electric power infrastructure in a net zero transition. And during COP26, Carlos Torres Vila, who's the chair of BBVA, shared that in Latin America in particular, there needs to be a bolder support from the developed world to the developing world. And, there's a big perception problem. It's very different sense of urgency in the developing world because they don't have basic access to energy. And now you're telling them, for families in Africa that spend decades saving money to buy a gasoline car, you're telling them to buy an EV car and spend another decade saving money. That's just not part of even an answer. And, the perception there is, curbing emissions will actually hurt growth, and these countries need growth, and they don't believe it's affordable. I mean, we discussed the amount of capital needed. They don't have access to that capital. So the fact that they're moving COP27 to Africa, it's all about the next phase of energy transition, which is just transition. If we don't make it fair and just for the developing world, there will be no transition because these people need basic energy needs. They need to improve their quality of life. So as we talk about net zero for the world, we can't do it alone, and we need to bring together the developing nations. So I think it's amazing that Egypt is going to host the COP27 next year. Mark, I think you're on mute. I waited to say this quote. I was like, I think you're on mute.
So when we did our practice session, I was on mute the whole time. So we were playing charades, and Yuliya was translating for me. So, but of course, you guys wouldn't know that though. All right. So Ryan, how should investors think about technology market, regulatory risk relating to emerging technology? I think you're on mute now, Ryan. Oh.
Yeah, I was. Great. I think this goes back to some of what we were discussing on early stage companies and proving pipeline. I think that investors are hyper focused on commercialization path. So there's certainly a lot that you can point to from like a regulatory standpoint of unprecedented support for these new classes of technology. It was very exciting to see that the infrastructure bill get passed, for example. And although that's not regulatory, it does show an aligned incentive between the government and the DOE and the desire to get these new technologies off the ground. The regulatory landscape definitely needs to evolve in some critical areas. Or, of course, the risk can vary dramatically, depending on the technology you're talking about. But I'd say that, for a lot of the newer technologies, that it does seem that a lot of the risk is more on like the technology side of things. It's easy to point to the market. It's easy to point to, and I guess the market question is answered with the pipeline. I think that when you can show MOUs, for example, if you can show offtake agreements, or if you can show competitive enough economics that are, going to be attractive to specific buyers, like those are the types of things that can help people get their head around the market risk. And then, regulatory risk, you just have to, I think you can point to a lot of the recent developments in funding and initiatives from Congress, or like even the EU taxonomy, the sustainable taxonomy is a great thing to be able to point to. So these are some of the things that I think investors are monitoring. There's not a lot individuals can do to push the needle on the regulatory front, but rather show how your business model still works under different regimes and which markets are most attractive, for example, which geographies, because this is a global challenge, which geographies have the most friendly regulatory environment, and how are you going to operate in those markets? So I think those are kind of the things that I would point to.
Excellent, thank you. Grace, Yuliya, do you want to take the same question?
Sure, I can give a go. So in terms of regulatory, it's very investment specific for me. I think Yuliya at McKinsey and Brian at the bank work maybe at a higher atmosphere. For me, I'm focused on direct investment into the companies. So two of the examples I give is on carbon capture. We look at adoption for the regulatory in really, really specific markets. In Spain, how would that work? In Canada, the carbon tax is already in place. So we actually do a lot of due diligence and a lot of research on market specific for which type. And the other one I'm working on is actually the requirement to measure methane in different areas. So it's definitely an interest to all of us. But when you say regulatory, to me, it's a little bit too broad. For me, on direct investments, I have to boil it down to the specific technology and what sector and what geographic market. And for the startups I would look at, we want to make sure their IP rights are protected, that overlay with the same geographic footprint on where we think the regulation will take off first to make sure it matches up nicely. So that's just to supplement Ryan's really good answer.
Excellent, thanks. And Jesse, I'm going to ask you to chime in there. I know I'm taking advantage of the fact that you're in the audience. So.
Yeah, and apologize. I think to solve climate change, we probably want to get rid of the leaf blowers, because I feel like my neighbors had this leaf blower pointed at my door for the last 10 minutes. So I think that the question was around how do you evaluate the regulatory framework around investments and how it impacts it. And so if I've got that right, I would say, foremost, I believe firmly that energy is policy. It's a longstanding belief. I had the opportunity, albeit briefly, to cut my teeth in the policy world, just doing black letter policy related to energy efficiency and demand response in Texas in ERCOT. And so I think it's not enough to say, well, here's a company that's highly dependent on policy, therefore it's not going to just organically make money. I think that's perhaps an overly simplistic view, in my opinion, of how these things work. So I think it's important, or it's the responsibility of the investor to, at least understand the policy frameworks, and the types of opportunities that they might create. An example would be in Europe, they passed a law in 2017 related to localized energy communities. And I'm sure that many on the phone have not heard about localized energy communities before. We've all heard about microgrids, we've all heard about nanogrids and so forth, but and we've also seen technologies that sort of fit into the microgrid / energy management, energy optimization construct. But when you have something like localized energy communities, it's this idea that you have a constrained environment, let's call it a military base or a senior village or a subdivision. And, as more and more distributed renewables come online and more distributed storage comes online, there's sort of this question about how to send the electrons to the place where they're actually going to be needed at the time that they're going to be needed. One approach to that is perhaps peer-to-peer trading, where if I produce solar all day on my roof, but I'm at work all day, maybe my neighbor is home and she could use that solar, perhaps to power the leaf blower. So, could you then do a peer-to-peer thing? Well, yeah, in theory you can, but I think a lot of people are thinking, well, that leaves out the utility. And generally we have policy in this country that any energy transaction, electricity transaction that is, needs to go through the utility, who of course is responsible for maintaining the wires at a minimum that transmit the electricity. And so what Europe has started to do is come up with policy frameworks that says, let's effectively mimic peer-to-peer trading in a constrained community so that electrons can get delivered where they need to be at the time they need to be delivered. We can do that in a way that reduces carbon consumption or carbon emissions, and increases system efficiency, and also keeps the utility very much involved, because the utility is tasked with typically reducing their emissions over time and meeting goals around efficiency. And so this can be a tool in the utilities tool bag, keep them incentivized to maintain the wires, but also use software platforms inside these localized energy communities to create a more efficient system. And so that's just an example where there's a policy framework that's nascent, but you could see how it evolves to kind of break through the sort of clutter of just standard energy management and actually get to something that really starts to create new, quote unquote, new sources and uses by just using existing sources and uses in a more constructive way.
Mark, I can add to that. U.S. regulatory staying as McKinsey proper and apolitical, it is very complicated, from the government to state to local. And if we just stay on the example of utilities, I think everybody who's worked with the utilities know they're not risk takers at all. For the most part, they're set up and required by regulators to deploy proven and mature technologies. We all know that our power grids are old and unreliable and carbon intensive. And I mean, even thinking nobody's thought about Bitcoin mining decades ago and the effect it's going to have on the grid. That was not even scenario planning. And these tendencies do present a lot of limitations. But, speaking to what we discussed earlier with Ryan and the collaboration across the various players in the sector, for example, if innovators and grid operators work together. So, for example, on accelerating the scale of long duration storage, and if regulators, I got this word, could send helpful signals. So, for example, either defining a mechanism to reward providers of battery storage and other services that help deal with the intricacies of renewables, then the following technologies could help create a zero carbon grid. But it takes several players to work together in collaboration with the help of our regulatory incentives.
Thank you. I really appreciate it. That was a very, very detailed answer, everyone involved. So Grace, BP Ventures being a strategic investor, how is that different from a financial investor?
Mark, that is a fantastic question. I'm really glad you asked me that. So let me, oh, can you hear me now? Yes?
Yes.
Yes.
Okay. All right, here's some nods, Okay, I see some nods, great. So I'm really glad you asked me that. A lot of times when people look for investment, they speak to BP. It's really more than just money they're taking. I'll explain it in two fronts. First, it's in the form of a commercial agreement. What I mean is, alongside BP Ventures investment, oftentimes we introduce that startup into a BP business. And the BP business will separately negotiate a commercial agreement with the company. Sometimes we're a customer, sometimes we're a collaborator, or sometimes we invest with the mindset to acquire the company once they grow to a large enough entity. For the company, it's fantastic because oftentimes it's guaranteed revenue, or they can take that as a LOI, MOU, take that to the market. It will actually secure more funding from other investors. Generally, $1 from BP Ventures attracts $10 around the table. 8 of them are equity and 2 of them are in the form of debt. So BP does really, really good due diligence on the company. That provides assurance to other co-investors. We look for financial VCs or other strategics to co-invest with BP. It's not very different from exploration well. You have all the super majors go in, share the risk. We do the same thing. Our model is very much collaborate now and compete later. Calling my buddy Jesse at Chevron for a minute. I believe, Jesse, we co-invested in a geothermal company called Ever, a Canadian geothermal company. That was my first deal with the ventures team done in 2020, sorry. So that's our model. And we keep a very strict Chinese wall between the ventures team. So my team, the ventures team, will negotiate a term sheet, and the BP business will negotiate a commercial agreement. Everything that the company shares with BP to do the investment, they have to share all their contracts, everything they have in their data room. We do not share that back to the BP business. And similarly, when BP takes a board seat, if there's a conflict interest, if they're discussing sales with a competitor, the BP venture members will actually recuse themselves from the meeting. So we don't share or do anything to jeopardize the company. So that's what I meant being a strategic investor. Financial return is great. That's absolutely the foundation we look for, because a company that doesn't make money delivers zero strategic value. But that's only the tip of the iceberg for a strategic investor like BP Ventures. We really look for collaboration, being a customer, first customer. In many cases, beyond that, that delivers huge strategic value to BP.
Jesse, you want to chime in? And Ryan, looks like you wanted to say something on that too.
Yeah, happy to chime in. I would echo a lot of what Grace has said eloquently. I think that if you're going for strategic value and you're doing that in lieu of financial value, that those two don't line up very well, right? If you don't have conviction on the ability of a company to make money and produce good returns, then in my opinion, it's hard to have conviction on the company, including their management team. And Grace is right. I think you end up with no strategic value, even with the best idea. Making money has to be at the forefront of it. I would say our future fund is set up a little bit differently in the sense that we are very purposefully targeting the right combination of innovation and business model on the 3 to 5 year horizon. So we're really trying to look for novel approaches, both in terms of execution and technology development, that will really start to make sense and commercialize on a little bit longer time horizon. And so that allows us a little bit more flexibility to kind of peer over the fence and see what's coming and where it's going, and try to be heavily informed by that. And so we don't have an imperative with the future fund to push technologies out into the Chevron businesses anytime soon. And some of them just frankly won't be a good fit, but we will see the green shoots of interesting new business models that are technology enabled, and it can get us thinking about where to go from here.
All right.
Yeah, thanks, Jesse and Grace. I was just thinking, when it comes to strategic capital, this is a form of vetting that, so I just wanted to piggyback on that idea that strategic capital is a form of vetting that opens the door for more financial, or I guess strict financial investment from private equity or venture elsewhere. And I think that's because strategic capital tends to be very commercial focused in terms of looking very hard at the viability of a technology or a concept to be deployed in a specific or specific market, for example. And I think that strategic capital can come from a lot of different sources. I think one of the popular things right now is these consortiums that seem to exist around, like, utilities have formed several consortiums, even though they're not great risk takers individually. They can team up and try to identify technologies that will improve their business model in the long run. And you could say the same thing about the majors and looking for ways to improve their business models, as has been discussed, but also explore new markets. And there's even non-traditional strategics that are pretty important to keep track of, I think, for these newer companies coming from like the tech side of things, or the software side of the house, that we're seeing play more and more in the area. So I just wanted to point out, though, that regardless of where that traction's coming from, it has the same, even if there's no associated offtake agreement or commercial contract that's coming along with that strategic capital, the capital itself and the partnership goes a long way in validating the technology and the idea.
Excellent. Yuliya, how much technology exists today to help solve the net zero equation?
I think we addressed that earlier.
We addressed that earlier. Yeah, no, okay, no worries. I got lost in the mix. So back to you, Yuliya. The need for innovation makes the pace of decarbonization difficult to predict. When, for example, will clean hydrogen cost $1 per kilogram, 2025 or 2050?
Sure, that's kind of the big questions that all the companies are looking for, and it goes back to Sunny's point of the valley of death and clean tech hurting cats, because when they speak with Jesse and Grace deal with this on a daily basis, but when you're talking with the engineers and investors and the stakeholders, all of them have a different risk appetite and reward appetite. So different multiple dimensions, but the answer of the decarbonization will definitely be affected by the speed at which these industries, from everything to aviation to steel, can decarbonize. If manufacturers of the EV batteries don't have the materials available to mine, like we can get electrification off the ground. So uncertainty about the financing and getting out of this valley of death is definitely a huge issue right now that the technologies are facing. But there are reasons to be optimistic in this world. If you look at the recent history, we can deliver necessary advances and cost reductions in technology. Like we've seen over the past decade, the cost of some renewable energy projects have come down by almost 90%. And so did the cost of EV batteries, LED lighting, all the other energy efficient hardware. And capital is increasing, plentiful, evidenced by the reevaluation of the clean tech stocks that began in June of last year, and just by the growth of investments earmarked by sustainability, ESG objectives, these new funds that are being formed. So, you know, we see governments are lending stronger fiscal support to low carbon investments. We see pledges from the big companies, not only to cut emissions, but also to decarbonize operations and product lines. You know, they're buying only renewable fuel, or you know, they're making claims that they're going to be selling only EVs by a certain time. So this confidence and should give confidence to entrepreneurs and their backers. And, you know, the talk of regulatory also mandates lends way to those demand signals. So I think we need to scale. That's we need to get out of the second valley of death and scale these technologies, and we will see costs going down dramatically. And that's kind of the hope for the industry.
Excellent, thank you. And let's see, can we, Ryan, what is the role of public-private partnerships in the commercializations of new technology?
Yeah, I think this kind of echoes back to something Yuliya said earlier about that these technologies only succeed with I think when she was talking about the regulatory environment. And I think most of these technologies are only going to succeed with partnership, and that includes the government in many cases. So when you know, when you're assessing regulatory risk, for example, and you're trying to describe how much of the business model is susceptible to regulatory risk, one way that you can help minimize that is through direct partnership. Sometimes, I know some folks in the chat have been throwing out grants as a great option for the Valley of Death. And, you know, and I would agree completely, because grants are a form of partnership that with universities or laboratories, or just directly with the DOE for as our means for de-risking first of a kind deployments. They're a way to explore new scientific advance and secure non-dilutive equity, or even low cost of capital debt. So I think that there's, you know, there's several programs out there that are designed specifically to catalyze advanced technologies, like the ARPA program is a great example, ARPA-E. But I think regardless of what it takes, I think it can also be very local. You know, as we discussed, regulation and regulatory risk is very local and technology specific. So sometimes state level, sometimes even city or county level, if you're talking about siting. But any you know, form of partnership with the government is again just another way of demonstrating traction, another way of demonstrating the ability to commercialize a product. So.
Excellent, thank you. And Grace, what is BP Ventures' role in the energy transition?
Yeah, thanks, Mark. So being incumbent in the business, being an oil and gas company, first of all, like, I think BP is leading the way in a way. Our CEO, Bernard Lee, is very, very vocal about us being a green company. And he's instead international oil company, he changed us to an integrated energy company. So from the very top of the house, he's sending that message loud and clear that we are going to transition. And secondly, BP has this really, really specific strategies and aims to lower the intensity of the carbon intensity of products we sell over time to hit the goal by 2050. And BP Ventures, how we fit into that overall strategy is we make really strategic investment that can help BP deliver our aims and ambitions. So I like what Jesse said. Like, I'm so envious of the new fund you guys set up. Our fund is just one fund, and we get to make 75% of the investment that deliver current strategy. But we have 25% leeway to make new investments in a way that could be wildcats. So in a way, it's a loop. Not only do we operating within the mandate of BP strategy, but at the same time, we work as a loop to look at what's out there, what's the new technology that's emerging, and then feed it back into the BP strategy. So that's the 75 and 25% mix to help deliver the energy transition. I wholeheartedly believe it's not one solution fits all. It's not just going to be wind or solar. It's going to be a mixture of many, many different types of energy. Imagine it's a symphony. It takes many instruments to make beautiful music. And that's what I think solar, wind, geothermal, electrification, carbon capture, every technology has a role to play to enable the beautiful music for energy transition.
Thank you, Grace. And I really love the way that everyone's interacting and shouting out everybody else. That's fantastic. Great community vibes in here. So Ryan, what is the role of nuclear innovation in the clean energy economy?
Yeah, pretty nuanced topic, but since you got me here in my background, worth talking about. So nuclear, I think, falls into a category that, along with several other technologies, maybe geothermal is a great example of new forms of clean baseload power. So there's a certain amount of decarbonization that can take place, or a large amount, majority amount, that can take place using existing renewable technology. But as you start to get the higher penetration levels, the economics of that become somewhat limiting. When you're trying to get from 80% to 100%, decarbonization and reaching net zero targets, that's where I think advanced reactor technologies become most relevant, because they lend themselves well to industrial processes, as an example, through direct heat, which is useful for things like desalination, hydrogen production as another potential, but also because they can deliver or promise to deliver economic power, with baseload characteristics, dispatchable power that's not limited by geography. So I think that I guess let me add a caveat for, benefit of the group is when I'm talking about nuclear, of course, there's a large existing fleet that's been providing, has provided 55 plus gigatons of CO2 emission to date, and is, I think, the second largest source of clean power to hydro in the world. But really what I'm excited about more is like the next generation of reactors that is aimed at economics that are comparable with renewables, and is aimed at safety enhancements that address some of the public concerns that are pretty well known from prior incidents in the nuclear area.
Yeah, I'm going to do a follow-up question to that, Ryan, and thank you for that answer as well. Why are advanced reactors gaining attention now? Isn't nuclear fusion 30 years away from us, 30 years in the future?
Yeah, I think that there's a number of co-innovations that like adjacent innovations that have taken place recently that have enabled us to think about these technologies differently. Namely, the advanced supercomputing that's available now, artificial intelligence, as a method for new reactor design and optimization, and material advances such as superconducting magnets. So some folks have probably heard of like the ITER reactor that's been under construction in France for quite a long time now, to explore one fusion design. And a lot of the fusion startups that have kind of spun off of that concept are in consequence of availability of superconductors that allow you to build the same thing a fraction of the scale. Advanced lasers is another thing. And then also the culmination of long lead research and development programs that have been government backed for the past 20, 30 years, for advanced fuels on the planet. So I guess, in terms of the timeline though, which is always an interesting question because fusion and, fission is a 1940s invention. And fusion has been an idea since for the same amount of time. And now though, because of all these new technology advances, this is I think the first time where it's really in striking distance. And when you couple that with availability of capital, that over $2 billion or $2.5 billion of private capital has been deployed against these technologies in the last 5 years, you start to see how we might be getting closer to the finish line, to the point where now there's over 50 startups working on advanced reactor technologies. Half of those are fusion, and there's a recent survey by the Fusion Industry Association where the company respondents, majority of them were indicating that first electricity to the grid from fusion is anticipated in the 2030s. So I think we're going to see a lot of ground breaks in the next 4 or 5 years. Definitely some technology shakeout as the physics is proved or disproved for several of these. But I think consensus is that there's multiple pathways at this point, and there's the money to make it happen, within a decade.
Mark, I can comment and piggyback on Ryan's comments and then Sunny's. I love your comments on the avocado campaign for nuclear, where I think nuclear energy has an uneven history. So from the 1950s of the promise of too cheap to meter energy to construction cost overruns in the 1970s. And then we have the post-Fukushima and Chernobyl fears. And on a personal level, I was born an hour away from Chernobyl. I was born in Kiev, Ukraine. So that is definitely hits close to home, and my family has experienced it firsthand. Do I want a nuclear plant being built outside my neighborhood? Probably not. Maybe we need an avocado campaign, but now the push to decarbonize power has lent new appeal to nuclear generation, which is emissions free. And so the emerging technologies where Ryan is a pro at this, but sodium cooled, molten salt, and helium cooled reactors are the next Gen 4, and nuclear and these small sealed modular factory built reactors and fusion energy is definitely an area where new startups are pushing costs down and timelines forward to prototype devices in mid 2020s, which is way ahead of the government backed research programs. So there's definitely progress. Sunny again brings a good point. There needs to be a moral case for why you want to build a nuclear plant. We've seen it with pipelines, how difficult it is, and bless their hearts of the midstream companies. And now, nuclear companies will face the same challenges with the communities.
And Mark, I'm going to just jump in there. The biggest issue is not with the technologies. I grew up a few miles from some of the test reactors up in New York. It's disposing of the waste. And until they get somebody that says, yes, you can put it here, that's going to be their Achilles heel. It's waste that lasts a long time. I think you can store it safely, but that's the problem with the nuclear, not the reactor itself.
Thank you, Roy. I appreciate you chiming in there. And so, Yuliya, we'll go back to you. An orderly transition to net zero would require significant changes to capital allocation. Raising and deploying capital will also be more challenging for specific sectors and geographies. What are some solutions that would make capital allocation decisions easier in your mind?
Sure. Happy to address it. Might get political a little bit, but I'll try to stay political. I think the big thing, at least in the US markets, that we're lacking is the increased transparency and just improving robust disclosures of emissions and scenario-based assessments of physical and transitional risk to inform the capital allocation decisions. Right now, we do not have a vetting process on ESG, and we're seeing the SEC making strands and trying to link ESG to the financial impacts and how do you report it? Because at the moment, it's not like a Deloitte can come in and do an audit on you and compare you apples to apples. So that's kind of the big challenge, is transparency and a standard disclosure that companies can benchmark. I think going back to just the amount of capital needed, we do need to develop and scale new financial products, new structures to help companies kind of wind down their legacy assets and scale up their low emission assets. At COP26, there's been a lot of conversations. How do you, the capital that was raised, how do you make it green now? And how do you allocate it to new projects and making it efficient? We're not telling to get rid of fossil fuels, but how do you make the operations cleaner? The whole question that brings up to the voluntary carbon markets. How can we develop and scale them in the near term? And the compliance markets over a longer term. So, and voluntary carbon markets would include markets both for avoidance credits. So, for example, to prevent forests from being cut down, and then for removal credits. So from afforestation or direct air capture. We do need to establish new and multilateral government funds to manage the ramping down again of assets and just maximize the value and risk from stranded assets. Like, what do we do with the existing infrastructure that might be stranded in 15 years? And then, bringing back to Ryan's and Grace's points of how do you de-risk the private capital and mitigating climate risk through like public guarantees or other risk hedges, and just support the capital flows into sectors and geographies where we do have a large financing gap. So I think those are some of the ideas that we have, but I'm sure there's a lot more people on the ground can offer new solutions.
Excellent. Thank you, Yuliya. And you mentioned ESG, and we haven't spoken about that in this conversation. So, Ryan, how is the clean energy and ESG capital market evolving? Ryan with Citibank.
Yeah, I would, there's a couple of things. One, I think that the LP or limited partner mandates are changing pretty dramatically. So what I mean by that is that many of the pension funds, sovereign wealth or institutional or otherwise, that are providing private capital to like PE and investment accounts, are taking hardline positions on ESG topics that are resulting in real shifts in capital availability. So as an example, like the natural resources focused private equity funds from a decade ago have now today shifted such that last year these same natural resources PE funds raised more money for renewable energy than they did for conventional. And these are some of the larger names, that you'll see around the conventional space. So that creates and then I think you'll see the same thing kind of in the public sphere. So capital is being reallocated, or rebalanced, maybe is another word. And it's also, again, I think we've hit this a few times, but it's also, as it's as the priority is shifting towards clean energy or energy transition, that means that also like the investment characteristics were like have to change slightly. And I think that's why we saw like the surge in new funds getting raised for this for ESG specifically, and also SPACs that are going after ESG companies specifically.
Anyone else want to chime in on that? Yuliya, Grace, Jesse? No? All right, fantastic. We'll move on. So, Grace, what do you think is important to consider when making an investment? I think we had other folks answer this, but you haven't yet. So,
Sure, Mark. So actually, this is a fun fact. I was actually just asked this question during my interview for BP Ventures. So my answer hasn't changed after 1.5 years in the team. So the answer I was giving at a time was you got to look at the management team, because you're not only investing in technology, but you're actually, more importantly, you're investing in people. So I say, oh yeah, do the site visit, go meet the management, go meet people, the employees in the company. And I'm very happy to tell you, after 1.5 years, that statement still holds very, very true. In fact, I just got back from London to do a site visit for a potential new investment. So I think the Oracle of Omaha, Warren Buffett, he said he would not do business with anybody he doesn't like. It's very, very crucial to make sure that people you're investing in, you like them. Because each investment is like a marriage where you go in straight away, you have kids right away. It's not going to be easy to get out. You're in it for the long haul. And being hard technology investors, it could be 10 years before we see an exit option, because you have to wait for the first commercial plant to be built. So think about really hard the founders. Can you see yourself getting along with them? Do you see eye to eye on the exit strategy, on the growth strategy? We had a few cases where we needed to replace the CEO or CTO or other positions in the company, and that's a very, very difficult thing to do. So I would say, besides all the normal checks and make sure the technology works, is really the people, the management team.
excellent.
Thanks for that question, Mark.
Yeah, no, you answered it from a totally different perspective from everyone else. So I'm glad that I revisited that that question with you. So, Yuliya, momentum has shifted. Net zero commitments are the norm, but demand for solutions and systems to meet them outstrips the supply. To respond, what should businesses focus on when it comes to net zero?
Thank you, Matt. So in many instances, the net zero commitments are running ahead of companies' own plans to meet them. So relatively few businesses have yet to make clear, detailed plans on how they will achieve net zero. It's very easy if you're a CEO that's about to retire in 2 years to say your company's going net zero in 20, and then the management is responsible for achieving that. So what we're seeing with speaking with investors, that the next phase, kind of where we are right now, is the leaders need to focus on how are they going to do this. We've heard at COP26, the UK Chancellor saying that the Treasury would require all UK listed companies to release net zero plans, not commitments, but plans by 2023. So in just 1 year. And it's only a matter of time, I think, before regulators and other stakeholders in other countries might follow this example. Until then, leaders who put convincing net zero plans in place can distinguish their companies from peers. They can get access to cheaper, but more accessible capital. To put just in basis, the competition is changing, and it's not just enough to make net zero commitments anymore. But these plans will vary in their specifics, and some companies will choose the strategy of being the last man or woman standing, which we also need that. And so, but the well-formed ones will feature, I think, certain elements. Definitely the emission targets of scope 1 and 2. The third one is ideal, but that's the hardest one to meet and gives everybody headaches. These should include long-term targets as well as near-term targets by 2025, 2030s, all aligned kind of with your strategy and just science-based mitigation trajectories or sector-specific trajectories. Each company needs to have a strategic view of climate risks and opportunities for each part of their company's portfolio, covering both competitive dynamics and just environmental exposures. Doing an assessment of spending of transition capital that will be required to reduce emissions, especially from existing emissions intensive assets, coupled just with a credible stance on the use of high quality carbon credits. And then also, a program for building capabilities to monitor external conditions, make decisions about how to update companies' plan and what trigger points do you need to look from a regulatory perspective or a changing customer demand that you need to pivot your company's strategy. And so, plans take time to prepare and business conditions are changing quickly. And I don't think companies should not wait to act. We're not saying that they need to implement these plans. You can have multiple plans ready, but while they draw their long-term agendas, they need to start with some of the moves. The quickest one to generate always value is investing in energy efficiency. We've seen that that's the biggest payoff right now. So I think that would be my several advice on how the company should focus.
Superb. And then I'm going to ask each of you a final question and then ask you to, just provide a summary. And then Jesse, I'll also ask you to provide a summary as well. You contributed a lot to the conversation. So Grace, can you talk about the support that happens for a company after an investment is made by BP Ventures?
Sure, Mark, very happy to. So I mentioned we're very, very active investors. Not only do we take board seats, we actually take on many, many different roles, whatever the company requires. Myself and several other BP Venture members, we do a ton of BD for the company inside BP and outside BP with our partners. So it's not only to help them grow, but we help them fundraise. So typically our budget every year is between 100 to 200 million. 80% of that is reserved for follow-on because we invest in Series A, Series B stages. We keep on investing because they need money to grow. They need money to build that commercial plan. I think equity financing is not the cheapest financing, but sometimes it's the only form you can get. So you use that to build your first commercial plan. So we talk to co-investors. We make sure everyone's comfortable putting their money in and getting that crucial bloodline into the company to make sure they can continue to grow. And I know I do a ton of BD for our portfolio companies. I call BP businesses. I cold call them if I don't know them. It is easier because I work in the same company. But we do that for all our portfolio companies. So that's the intangible piece that comes along with our financial support, whatever it takes. We also help them interview. We make introductions, many, many things. All right, back to you, Mark.
Thank you very much. And as you can see, folks, it's not just money. There are various other things that you're doing, especially at BP Ventures. So Ryan, I am going to, what milestones should investors pay attention to? I think I asked you that question already. Is that correct?
I think we touched on it, yeah, but I mean, I guess you're relating to if you want to keep track of advanced reactor progress. There's a couple of programs. Yuliya mentioned like the government-backed program. So if this is a topic of interest, recommend you keep your eye on the Advanced Reactor Development Program that's backed by the DOE and was just received further appropriation via the infrastructure bill. So that's $2 billion in funding that the DOE has put towards first of a kind demonstrations of molten salt and helium reactors. In addition to the carbon-free power project, which is a small modular reactor that's also receiving similar 50-50 cost share from the DOE. there's a few other programs that are worth noting. I think the on the DOE's also got something called the Advanced Reactor Risk Reduction Program, which if you want to look at concepts that are a little further out but have greater promises in terms of cost reduction or maybe waste reduction, was a topic that came up as well. And it's, if you're thinking of nuclear, then some of the big topics are going to be, how do you drive costs lower, how do you improve safety, and how do you reduce waste? These are some of the concepts that are being explored right now. On the fusion side, there's ARPA-E programs out there, but a lot of the activity is happening outside of government programs. It's with private capital. So for that, you kind of just have to watch the progress of corporate, press releases relating to net energy gain demonstrations that are all kind of slated in the next 4 years. So I think a quick Google on any number of these company names will get you results on when these projects are going to happen. But all of these projects, whether fusion or fission, are all going to play out in the next 4 years or 5 years. Between now and 2027, really, is when all these demonstrations are occurring. So there's a lot to monitor, I think.
I think I'm on mute. Excellent. So thank you for that. And then Yuliya, how can current asset owners and future investors manage risk and realize opportunities?
Why do I get the tough questions? I would suggest that, owners and investors alike must understand the speed of the transition over the next 10 to 15 years, as well as which markets will transition completely, requiring greenfield projects, and which will be merely impacted, so brownfield projects. Example, the midstream gas and transport sectors will eventually likely need to transition to accommodate green gas or hydrogen-based fuels, and the power sector could adopt CCS technology. So having a clear view of the challenges can help identify the opportunities and, more important, avoid risk from just stranded assets. But with this view in mind, companies do also need to leverage or attract new investments around both greenfield and brownfield projects, which requires very careful evaluation of existing assets and new investment opportunities. And, to Ryan's points, like the latest policy changes and to watch out. But I would just recommend, have a North Star, have a point of view to cut through the noise. Tell your story. It will be increasingly important for leaders to articulate their change to both the board and the investors, and just know that the opportunity is real, but so is the risk. It's not just a, pink colored glasses world we live in right now. And the various scenario planning and everything from green material sourcing will all be increasingly important. So just evaluate the risks and the opportunities.
Superb. Great answer, Yuliya. I know you can answer those questions. That's why I ask you. Super. And then Jesse, if you want to kind of just provide me with just a brief summary on your thoughts on corporate venture capital and the energy evolution, and then I'll cycle back through the rest of our panelists, and then we will close out. Please make sure you save the chat. Thank you for everyone for joining us, and I appreciate you. So Jesse.
Yeah, thanks, Mark, and thanks for organizing this. It's been a really great and robust discussion. I'll keep it very brief, as I know we're close to time. But with respect to corporate VC versus other flavors of capital, I think with the energy transition, my opinion is that it takes a village. You're going to need different types of capital for different types of applications. There's a whole range of technologies and approaches across this space, from the really hard to execute hard tech to software platform plays. And so we're going to need different flavors for different companies. And we're also seeing a lot of more patient capital coming into the sector. We're seeing more 15-year funds and evergreen funds, for example, that are recognizing that these are typically not software type business cycles. And so the capitalization is starting to adjust to that. For corporate specifically, I think that there's a real value add to this whole equation, in the sense that we understand how to do the hard stuff and how to scale it. And so the money, as Grace alluded to, is just kind of the tip of the pyramid. It's more about the capability sets, and entrepreneurs increasingly are recognizing that they need partners both in capital and in technology development that'll help get them across the line. They can't do it all themselves.
Excellent, thank you. I really appreciate you for joining us, Jesse. We need to visit after this too. Grace, your summary on corporate VC and the energy evolution.
I'm never very good at staying assignment. Can I just leave with a different thought? It's still a summary, but just a slightly different. Okay.
Be yourself.
Thanks, Mark. I think I want to leave the audience with a thought. It's an optimistic one. I think Houston is prime for energy transition for 3 reasons. 1, we've done it before, like the energy boom, we've done it before. So this is just a different energy that we're needing. And 2, because we've done it before, there's a lot of talent in Houston. We have the engineers, we have the sales pipeline, we have different talents in Houston already primed to start the energy transition and be the winner at it. And thirdly, there's so much oil and gas money looking for redeployment. You have to have the talent, the money, and the technology to make it work. But Houston, in my mind, is really prime for any transition. We're gonna win at this if we keep at it. So it's a little bit off topic, but I really want to leave this with an optimistic thought at the end.
No, I really appreciate it. Thank you very much for adding that. Ryan, and then finally Yuliya, and then we will close. And thank you everyone for joining us, the FENG Financial Executives Networking Group.
Thanks, everyone. It was a pleasure meeting the group. And again, I'd really like to keep the conversation going. I think that this is a rapidly evolving space. I think that it's hard to keep your finger on the pulse from day to day, but this is good news, and I think every day the opportunity set seems to expand. So I think there's a lot of interest. There's a lot of momentum. I think for those who want to be in the driver's seat or get a seat on the bus, I think there's plenty to do. And I think it really will be a 30-year effort. So I think we're in the first, not even the first inning really of making this actually happen. I think we're developing thoughts and ideas and strategies and resources, mustering resources to make it happen. But now, over the next decade, we're going to have to start putting shovels in the ground and actually doing this. So there's going to be a lot more. There's a lot today. There's going to be a lot more tomorrow.
Fantastic. That was a great insight. And then Yuliya, I appreciate you, and we will end our session with the FENG Financial Executives Networking Group.
All right. Yeah, we're doing parting comments 2.0. But to Grace's point, Ryan, I mean, we're in a great industry. It's here. It's not going away. We're just trying to make it cleaner. We've done these transformations throughout the whole humanity, so this is nothing new, but we just now are equipped with more talent and more technology and more power than we know what to do with. So we just need to, I think, collaboration and working together. And I think they've just proven how US was able to do this in shale, and not many other countries can replicate. But we cross-share knowledge, we're a tight community, we network, we have these conversations like this where it's open and people share their challenges and are vulnerable and talk about opportunities and how to collaborate. So I think we need to continue with the culture of collaboration and taking risks, failing, learning from it, and doing it better the next time.
Wonderful. This was a very exciting conversation. I really appreciate all of my panelists. Thank you so much for joining us. My name is Mark Hamzat Erebogbo, Chairman, Energy Natural Resources of the FANG Financial Executives Networking Group. Thank you for hosting us. Feel free to log on to the FANG for various other different talks in different industries. We have 41 special interest groups, so you can go ahead and have at it. This was wonderful, guys. I'm so excited and I'm really energized, pun intended, after this panel. Take care. Thank you very much. Have a great day.